Assalamu alaikum. When to refinance your mortgage? Refinancing can save you money or cost money. Refinancing mortgage means paying off an existing loan and replacing it with a new one. There are many reasons why homeowners refinance: to obtain lower rate of interest, to shorten the term of their mortgage, to convert from an adjustable rate mortgage to a fixed rate mortgage, or vice versa, to tap into home equity to raise fund, to deal with a financial emergency, finance a large purchase of consolidate debit. Since refinancing can cost between 3% to 6% of loans principal, and as with an original mortgage requires an appraisal, title search and application fees, it's important for a homeowner to determine whether refinancing is a wise financial decision. Key takeaway: basically, getting to a mortgage with a lower rate of interest is one of the best reasons to refinance. When interest rate drop, consider refinancing to shorten the term of your mortgage and pay significantly less the interest payments. Switching to a fixed rate mortgage or to an adjustable rate one can make sense depending on the rates and how long you plan to remain in your current home. Tapping equity to consolidating debt are other reasons to refinance, but beware, doing so can sometimes worsen debt problem. Refinancing secure a lower interest rate. One of the best reasons of refinance is to lower the interest rate on your existing loan. Historically, the rule of thumb is that refinancing is a good idea if you can reduce your interest rate by at least 2%. However, many lenders say 1% saving is enough for an incentive to refinance. Using a mortgage calculator is a good resource to budget some of the costs. Calculate your monthly payment. Your monthly mortgage payment will depend upon your home price, down payment, loan term, property taxes, homeowners insurance, and interest rate of loan, which is highly independent of your credit scores. Use the inputs below to get sense what your monthly mortgage payment could be and by a being. Instopedia essential: reducing your interest rate not only helps you to save money, but it also increase the rate at which you build equity on your home, and it can decrease the size of your monthly repayment. For example, a 30 years fixed rate mortgage with an interest rate 5.5% on an $1 lakh home as a principal, the interest of $568, the same loan at 4.1% reduce your payment $4.77. Mortgage lending discrimination is illegal. If you think you have been discriminated against based on the race, religion, sex, material status, use of the public assistance, national origin, disability, or age, there is the steps you can take. One such step is to file a report to your Customer Financial Protection Bureau or with the U.S. Department Housing Urban Development. So the consumer fashion, basically housing urban development, refinancing to shorten the loan term. When interest rate fall, homeowners sometimes have the opportunity to refinance an existing loan to another loan that without much change in the monthly payment has a significantly short term. For 30-year fixed rate mortgage on a $1 lakh home, refinancing from 9% to 5.5% can cut the term in half to 15 years with only a slight change in the monthly payment from $805 to $817. However, if you are already at 5.5% for 30 years, $568, getting a 3.5% mortgage for 15 years would raise your payment to $715. So do you math and see what's work. Refinancing convert to ARM or fixed rate mortgage. While ARMs often start our offering lower rate than fixed rate mortgages, predict adjustment and can result in the rate increase that are higher than the rate available through a fixed rate on mortgage. When this occurs, converting to fixed rate mortgage results is a lower interest rate and elimination concern over future interest rate hikes. Conversely, converting from a fixed rate loan to ARM, which often has lower monthly payment, then a fixed term to mortgage can be a sound financial strategy if interest rates are falling, especially for homeowners. How to do not play to stay their home for more than a few years. These homeowners can reduce their loan interest rate and monthly payments, but they will not have to worry about how high rates go 30 years in the future. If rates continue to fall, a predict rate adjustment on an ARM results in decreasing rate and smaller monthly mortgage repayments lamination. The needs to refinancing every time rates drop. When your mortgage interest rates rise, on the other hand, they would be an unwise strategy. Refinancing to tap equity or consolidate debt. While the previously mentioned reasons to refinance are all financially sound, mortgage refinancing can be slippery slope to never-ending debt. Homeowners often to access the equity in their homes to cover major expenses such as the cost of home remodeling to a child colleague education. These homeowners may justify the refinancing by the fact that remodeling adds value to the home of the interest rate of the mortgage loan is less than the rate of the money borrowed from another source. Another justification is that the interest of mortgage is tax deductible. While these arguments may be true, increasing a number of years that you on your mortgage is rarely smart financial decision, nor is spending a dollar on interest to get 30% tax deduction. Also note that since of the tax cut and job act went into effect, the size of the loan which you can deduct interest has dropped from $1 million to $7,50,000. If you bought your house after December 15 to 17, मतलब may homeowners refinance to consolidate their debt at face value. Replacing high interest debt with a low interest mortgage is a good idea. Unfortunately, refinancing does not bring automatic financial producer. Take this step only if you are convinced you can resist the determination to spend once of the refinancing reveals so from debt. Beware, be aware that the large percentage of people who once generated high interest debt on the credit cards, cars, and other purchases will simply do it again at the mortgage refinancing. Give them the available credit to do so. There is creates an instant to quadruple loss composed to wasted fees of the refinancing, lost quality, instant tradable in the house. Additional year of the increased interest payment on the new mortgage and the return to high interest debt once the credit cards are maxed out again. It's possible that the result endless repetition is the debt cycle to eventual bankruptcy. Another reason to refinance can be serious financial emergency. If that is the case, carefully research all your options for raising funds before you can take this step. If you do a cash out refinance, you may be the charged a higher interest rate on the new mortgage than a rate and refinance in which you don't take a money. The bottom line, refinancing can be the great financial move. It reduces your mortgage payment, shorten the term of your loan, or helps you to build equity more quickly. When used carefully, it can be also valuable tool for bringing debt under control. Before you refinance, take a careful look at financial situation and ask yourself, how long do I plan continue living the house? How much money will I save by refinancing? Again, keep it in mind, refinancing costs 3% to 6%. The loan's principal, it takes years to recoup that costs. The saving generated by a lower rate of interest in shorter term. So if you are not planning to stay in homes more than a few years, the cost refinancing may be negated by a potential saving.